So you've worked hard, you've saved some money, and now you want to put that money to work. Great, but let's be honest. Turning those savings into a smart investment portfolio can feel, well, a little intimidating. Today, we're going to cut through all that noise and give you the single most important tool that the pros use. It's called a financial blueprint, and it is the key to building your financial future on a rock-solid foundation.
I mean, this is the question, right? You've got some cash ready to go, but where do you even start? Stocks? Bonds? Crypto? Real estate? The options seem endless, and that fear of making a really expensive mistake, it's real. It's so easy to get totally paralyzed by choice before you even make your first move.
So how do the professionals get around this? Well, here's the secret. They don't start by picking investments. Nope. They start with a plan. A personalized, written plan that becomes the foundation for every single decision they make from that point on.
Now, this plan has a pretty formal name. It's called an investment policy statement, or an IPS. And yeah, it sounds a little dry, I get it. But what it really is a document that clearly lays out exactly what you want to achieve and the rules of the game you have to play by to get there. It is the absolute, non-negotiable starting point for managing your money the right way.
Honestly, the best way to think about an IPS is like an architect's blueprint for a house. You wouldn't just hire a crew and tell them to start throwing up walls and hope it turns into your dream home, would you? Of course not. You'd have a detailed plan. The IPS, that is the plan for your financial house.
And every single blueprint, whether it's for a skyscraper or your retirement, starts with the most important question of all. What are we actually trying to build here? In the world of finance, this translates directly to your investment objectives. What is the ultimate point of all this money?
And really, your objectives boil down to two main things. First, your return requirement. That's the amount of growth you need to hit your goals, like, say, retiring by 60. And second, your risk tolerance. How much of a roller coaster ride you can handle to get that return. And these two things have to be in balance. You simply can't shoot for massive returns without being willing to accept some serious risk.
Now that phrase, risk tolerance, sounds simple enough, but believe me, it is one of the most misunderstood ideas in all of investing. Most people think it's just about filling out some quiz that labels you conservative or aggressive. But the way the pros look at it goes so much deeper. And getting this part right, it's absolutely critical.
You see, professional advisors break risk tolerance into two completely different parts: your psychological willingness to take risks and your financial ability to actually handle those risks. And trust me, understanding the difference between these two is a total game changer.
Okay, this is the key. Willingness is all psychological. It's about how you feel. It's your personality, your gut reaction when the market takes a dive. It's totally subjective. Ability, on the other hand, is purely financial. It's the cold, hard facts, your income, your net worth, how long you have to invest. It's objective. And here's the crucial part. Those two things are not always the same.
To make this crystal clear, let's dive into a case study from our source material. We're going to meet two brothers, Henri and Jacques Gascon, and their stories perfectly highlight this potential conflict.
Okay, first up is Henri. He's an energy trader pulling in a high, stable salary. He's already got €1 million saved up, and he has a solid 20 years before he even thinks about retiring. His financial situation is a fortress. Objectively speaking, his ability to take on investment risk is very, very high.
Now let's look at his brother Jacques. Jacques is a self-employed consultant. His income is much lower, and it's unpredictable. He's got very little in savings, and his time horizon is short. He needs that money in just a few years for his kids' college tuition. Jacques' financial reality means he has a very low ability to take risks. A big loss for him would be completely devastating.
And here's the twist in the story. Psychologically, both brothers are risk takers. They're confident, they're not scared of a volatile market, they both have a high willingness to take risks. Now for Andre, that's fine. His ability and his willingness are perfectly aligned. But for Jacques, this is a dangerously bad mismatch.
So, how does a professional deal with this kind of conflict? Well, they follow one simple, very wise rule. Your true risk tolerance is always determined by the lower of the two factors. Your financial reality, your ability, has to win out over your psychological desire. So for Jacques, that means his low ability demands a low-risk portfolio, no matter what his gut is telling him.
Okay, so once your objectives are locked in, the next part of the blueprint is to define your constraints. Think about it this way. If your goal is the house you want to build, the constraints are like the property lines, the budget, and all the local building codes. They're the boundaries you absolutely have to work within. And there are 5 key constraints that are going to shape pretty much every investment strategy. Together, they paint the complete picture of your financial life. Let's just walk through each one really quick.
First up is liquidity. This is all about any big, upcoming needs you have for cash. If you're planning on buying a house next year or paying for a wedding, that money cannot be tied up in some risky, long-term investment. Your portfolio has to be ready for those cash needs, making sure the funds are safe and ready to go right when you need them.
Next, your time horizon. We saw just how critical this was with the Gaskin brothers, right? Investing for retirement that's 30 years away is a totally different ballgame from saving for a goal that's only 5 years out. A longer runway just gives you more time to bounce back from any market downturns, and that directly increases your ability to take on more risk.
Taxes. You can't forget taxes. They are a huge constraint. How your investment gains are taxed can completely change your strategy. For instance, in a tax-free retirement account, you might be more active, but in a regular taxable account, you might want to buy and hold to put off paying capital gains taxes. The goal is always to maximize what you actually get to keep.
Then there are the legal and regulatory factors. These are the official rules of the road. And this isn't just for big institutions. It could be the rules governing your company's pension plan, or maybe legal restrictions that stop a corporate insider from selling company stock at certain times. These rules are totally non-negotiable. And finally, we have unique circumstances. This is kind of the catch-all bucket for everything else that makes your situation, well, yours. Maybe you have really strong ethical beliefs and you want to avoid investing in certain industries. Or maybe, like Henri the energy trader, you've already got so much of your financial life tied to one industry that you need to actively invest away from it in your portfolio.
Okay, so you've done the hard work. You've figured out your objectives, you've defined your constraints, you've got them written down in your IPS, you have your blueprint. Now, and only now, are you ready to actually build the portfolio.
And the process from here is actually pretty logical. You start with your IPS. That's the document that's all about you. Then you combine that with a professional view of the markets. What are the potential future risks and returns of things like stocks and bonds? And when you fuse your personal needs with the market's possibilities, you get your strategic asset allocation. And that's just a fancy term for the long-term target mix of investments that is perfectly tailored for you.
And here is what the final result can actually look like. This example, which is based on a German entrepreneur from our source material, shows a portfolio that was built directly from a blueprint. His specific goal, a 6% return with 12% risk, led straight to this exact mix of assets. See? It's not guesswork anymore. It's a portfolio that's been engineered to meet a very specific plan.
And that really brings us to the single most important takeaway from this whole thing. So many people think that successful investing is about predicting the market or finding the next hot stock or timing their trades perfectly. But it's not. Real sustainable success starts with the deeply personal work of understanding your own goals, your own psychology, and your own financial reality. Your investments, your savings, all of your financial decisions, they tell a story. They tell a story about your hopes, your fears, your ambitions, and your plans for the future. So the question I want to leave you with is this. If you sat down today to create your own financial blueprint, what story would it tell about you?